I just want to set the tone for the week. And I want to introduce Dr. Kepler. I've known him for several years. I haven't actually met him in person until today. So it's a great pleasure. Yeah, 10 years. I can't believe it. But there's been a lot of guys that have gone through or still use Market Delta that have learned market profile from him. He's certainly a great resource for that, and I'm just excited to be able to have him as one of the speakers, as well as Dr. Steenbarger. It's just going to be a great setup here this week. So without any further ado, I want to go ahead and turn it over to Dr. Kepler.
Let me welcome everyone here today, and I'd like to go ahead and get us started with our venture into the idea of peak performance as a trader. I was once a student of someone whom you might have heard of, the author of the book 7 Habits of Highly Effective People. His name was Steve Covey. He's no longer with us. He's since passed away, but he was actually one of my professors. And one of the key habits of peak performers that he had identified in that book was sharpen the saw. Effective people who in fact become peak performers are always working to sharpen the saw. What do we mean by that? Learning, acquiring new skills, being open to find better ways to improve and to do things. And your presence here demonstrates that you have that skill. So if anything, I want to tell you that all of you have demonstrated that you have the potential, in fact, for peak performance. And so now the key is to guide you onto the path to help you, in fact, become peak performers. What does it take to become a peak performer? As a trader, what do I need to have? What competency, what skill? First and foremost, you need to be able to identify in advance future market direction. 3 things I will also encourage you to do throughout the day today. First and foremost, never hesitate to ask a question. There is no such thing as a stupid or silly question. Ask all you want. We are all here to learn, and the best way to learn is to ask questions. 2, make sure you take notes. You will find that you will want to sort of reference back something that we talked about, and your notes will help you with that. So take notes. And last but not least, also try to engage with everyone here that's participating. Everyone here has something valuable to share, and certainly we all want to benefit from one another. All right, so back to my slide. The most important thing is to have this ability to be able to anticipate the future direction of the market. Next, you need to be able to identify high probability rewarding trade opportunities. There are always many different opportunities. Some of them I may be able to get a tick or 2 here and there. That would not be what I would identify as a high probability or a most rewarding trade opportunity. Now, some may choose just sort of, I just want 1 tick, 2 ticks, and I'm out. That's a particular strategy, but certainly that's not the hallmark of peak performers. The ability to identify profit targets. I heard as we were going around the room, a lot of you mentioned sort of not knowing when to stop, at what point sort of to manage greed or to manage a trade. What we're going to look at together is the fact that you should always have milestones for any trade. And you should always at least know that the highest probability milestone, once you reach it, you've reached that one, and the probability begins to decrease as you look at the next profit targets. Ability to effectively manage risk and exit planning. This is another one of the hallmarks of effective traders. You must know how to manage risk and when to exit. The ability to execute properly. Many of my students have a system that we've developed together and work with the system, but then they screw it up on execution. They panic, they freeze, they hit the wrong button, the wrong price, and so execution is another skill that one must learn to master. And last but not least, the ability to control emotion and self-discipline. Anything else anybody would like to add to this list in terms of competencies for peak performance? You feel that we've adequately covered what we need to know? All right, good. All right, so now we are going to look to market profile as a tool to help us achieve this peak performance. And hopefully, has anyone never seen a market profile before? Hopefully everyone in the room has at least seen a market profile before. Okay, we have one person who has not. Okay, well, if you haven't seen it before, this is what it looks like. Yeah. All right, and this is a profile for, each profile is for a specific session. And that's one of the key things to remember, that I have to be cognizant of what session I'm looking at with my profile. In this case, these happen to be for the ES. And by the way, we'll talk about different instruments, but I'll use the ES as sort of our base model. Okay, so this particular profile, as a tool, what does it really help us with? First of all, it helps us to identify pending market direction. Remember that skill we talked about in terms of peak performance? The ability to be able to identify where the market is going? Well, this tool, I will demonstrate for you, will help you to do that. It also helps us to see what's happening with the auction process within the market. It also helps us to identify potential rewarding trade opportunities, profit target levels, and how to effectively manage exits and risk in a trade. So look at all of the benefits of the profile. What I'm trying to do is convince you or persuade you that this is a tool that is very worthwhile to use. And my job now is to continue to present to you how it can really enhance your performance and how it can, in fact, do this. But before we do that, I have to make sure you also understand the limitations of the profile. The profile is not a signal system. A lot of my students say to me, well, why don't you just show me where to get in and where to get out? There is no light that's going to go on and off with the profile telling you get in here, exit there. It requires some of the fundamental mathematical analysis that you alluded to earlier. So there is a level of sophistication in using the profile. It's not necessarily sort of simple and intuitive. You really have to be able to analyze what the profile is telling you to gain the benefits from the profile. Now, that's good and that's bad. It's good because not many people are able to do it, and therefore the market makers, the more sophisticated aspects of the profile, they don't tackle. Oops. Or they don't conceal, I should say. They know that most people don't see this, some of the things that we will be looking at, and so it's not something that they target intentionally to conceal from the public at large. That's the good aspect of the profile. The more talented you are at understanding the profile and extracting good information from it, the more of an edge you're going to have in the market. Because you will see some of the things I will show you, many people simply just do not see them because they don't know what to look for. They don't know how to look at them. Now, that's the good part. The bad part is it does take effort and it is not easy. But once again, if you are going to compete with some of the most talented, some of the most sophisticated, and some of the wealthiest people in the world, did you ever really think this was going to be easy and sort of a piece of cake? And in fact, if it were, then everybody could do it, and life doesn't work that way. So expect that you are going to have to do a certain amount of work, and you're going to put energy into the process. It's not intuitive or simple. The other thing about the profile, that it is not the only useful tool. It is a very powerful tool, but Anytime I hear these people that say, oh, I'm a profile trader, you're an idiot trader. There is no such thing as being just a profile trader. Trading is about acquiring as much knowledge as you can about the market. Profile happens to be a tool that's an effective tool. But it doesn't mean I throw away everything else and that's all I want, and that's sort of the panacea that will save me. So you always need to put things in perspective. And now remember, this is coming from someone who's actually written a book on the profile. So even though I recognize the power of the tool, I don't necessarily see it as the panacea, and there are other things I will look at, and I will encourage you to do the same. Now, the profile is not found in all platforms. And one of the very important things is to make sure that you select a platform that will give you some of this information that we're going to talk about today, because I will tell you it's not found in a lot of different platforms. And it's important. And the more you're able to see things that others do not see, the more power, the more knowledge you will have in the market. Okay, so just to summarize, the profile is nothing more than a visual organization of market data. It's a technical tool. It's a technical, not a fundamental tool. Now, someone earlier had mentioned that they had an interest in learning more about the fundamentals. I want to tell you the fundamentals are helpful, but the technicals are always ahead of the fundamentals. Because the people that know the fundamentals react on those fundamentals ahead of everybody else. So often you will find the market do something, and then the explanation of why the market did it will come later. The profile is an effective way for us to analyze market activity. And it's really the only tool out there that really organizes for us in a coherent way the actual market activity. It is a way to identify price zones that include high levels of activity. Show me any candlestick in the world that will show you where the high level of activity was within that candle. However, now think, I'm not saying candlesticks are bad, I'm just telling you a candlestick on its own is inadequate. Imagine now if I begin to take a look at the profile of that particular candlestick. I now have an ability to identify the zones within that candlestick that demonstrate high levels of activity, whatever that candlestick may be. Show me another tool that can actually organize us for the organize market activity data for us so that we can understand the auction process and what's going on in the auction. Because ultimately, any electronically traded instrument trades on an electronic auction. And back to the issue of randomness. There is no such thing as randomness. You have to have rules in the auction, right? If you have a random auction, someone says, okay, I bid X. Well, we're not going to give it to you. Somebody says, I'll bid Y. Okay, we'll give it to you instead. That's a random auction. There is actual order, rules, and organization of that auction. And so you must understand how auctions work. Yes, sir?
So how do you distinguish between random and probabilistic?
Okay.
Markets are probabilistic.
Absolutely, absolutely. Two different things altogether, all right? Now, the probability of something likely to happen is not based on randomness, it's based on what's happened before, the events that have occurred before it. Even in statistics, when you take a look, you look at a series of events and you calculate the probability on that basis, correct? And if the events happen to be random, then in fact you're looking at the probability of random events. What I'm arguing to you is that these events are not really random. Let me backtrack for a moment and talk about market participants and to re-emphasize this idea, the lack of randomness in the market. First of all, who has the ability to influence and move markets? I'm sorry?
Big money.
Big money, absolutely. Big money, all right? What do we mean by big money? Who's big money? Goldman Sachs, okay. I'm glad you mentioned that. I have a number of friends that work for Goldman, and I had a conversation with one of them a few years back. And I was saying to him, how do you guys get it right all the time? I mean, they have an incredible success rate. You know, how are you able to predict the markets so accurately? And you know what he said to me? We don't predict. We make. We make the market. And then he began to explain to me that the clients that Goldman has are high net worth clients. You have to have a certain amount of threshold for Goldman to entertain you as a client. Any of you here have Goldman accounts? All right, okay. So you don't know what we won't talk about this, the threshold. Suffice to say, it's significant. All right, now, here's what a Goldman financial investor will do. They will go around, talk to a bunch of these clients, and they will say, we think Microsoft is going to go up. Can I count on you for 10 million? Can I count on you for 5? Can I count on you for another? And then they'll amass a pot of money from their clients that have committed to investing in this particular instrument. So guess what? Microsoft is going to go up because now somebody is going to put a few hundred million, perhaps even more, into Microsoft. So what does Goldman do? Goldman then begins to invoke their own in-house buying algorithm for that particular instrument. I mean, I mentioned Microsoft, not to be specific, but just any instrument, let's say. They begin buying, all right? And then at some point, they begin selling back to the clients that they've promised. And then they buy up again, and those clients make money. In the meantime, Goldman is always fronting what they're selling back to their clients. So you see a pattern in the market which you constantly see, which is this zigzag. Buying, selling, buying again, dropping. In the old days, we used to call this a bull flag. Okay, so this is old stuff. I mean, it's not, the pattern may not have equal flags as it used to back in the old days, but that's the same thing. It's a buying algo, and it buys back and so on. The clients still make money, don't get me wrong. All the clients will continue to make money. But Goldman is making more, all right? So that's how it works. So random, there's nothing random about this. It's very well planned, it's organized, and it works very efficiently and very effectively. So what is my job? I am the little ant that is looking for Goldman's footprint. Goldman is the shark, all right, coming in. And my job is to identify their teeth marks. And I will show you when they come in to take a bite what it looks like. If it's Goldman or someone else. It doesn't necessarily have to be Goldman. It could, in fact, be the market maker for that particular instrument. But these are the guys that move the markets. It's not you, it's not me, it's not all of us even together. It really needs a significant amount of money, and it's an orderly process. And it happens over an extended period of time. So once you understand these buying activities or selling activities for that matter, you begin to know that my job is to recognize these patterns. The first thing that I want to share with you is that this particular visual representation of the profile is known as a TPO profile, a time price opportunities profile. So I'm representing the activity in a time, price, opportunity fashion. So there are many different ways to look at the profile. This is just one of them. And that's known as the TPO.
Is that the volume in the gray?
Yes, this happens to be the volume histogram for each of those price levels. And I will go in more detail about what each of those elements are. Yes, sir.
Now, do you use market profile and volume profile, or do you focus on like market profile over volume profile?
Both.
You
Both.
use both? Okay.
Absolutely. Absolutely. Okay, the first key element of the profile is what we call the value area. And what is this value area? The value area is nothing more than identifying the core or the bulk of activity within any session. Basically, rounded numbers, 70%. It's based on the normal distribution, which is usually 68%, but we round up to 70%. It doesn't really make that much of a difference as far as the percentages, but that's what we are trying to identify. Where was the bulk of activity within that session? And what did it look like? Okay. In this case, it's kind of interesting. We had a cluster at the top, and then we had a very thin level of activity on the lower part of the distribution. And one very easy thing I'm going to teach you right away that I would hope everyone will never make a mistake with, if I ask you now, at this particular cluster at the top, do we see buying or do we see selling? Yes, what?
Both.
Yes is not an acceptable answer here. I want to hear buyers or sellers at the end. Buyers, I hear buyers. Do I hear any sellers?
Did it happen before or after what happened down below?
Okay, very good question, all right. When did this profile start? When did the session start? The session started down here in period A, right? That little circle shows me the beginning of any particular period. So that's the open of that period. Each of those letters is a half-hour increment within the session. This happens to be a day session. All right, so those of you who said buying, why did you say buying?
We shot the price up.
I'm sorry?
Shot the price up.
Okay, now, absolutely, the session went all the way up to here, all the way up to the top. And then we began to develop a cluster. So actually, the buying was way below. At that point, what we have is really, it doesn't demonstrate strong selling, or we have acceptance at that level. We're starting to rotate up at that level. So now, one of two things are happening. We are gathering momentum. We've met some sellers, and we have to take all the inventory they have so we could move up, or in fact, those sellers could push us back right back down again, right? It's one of those two possibilities. So the correct answer is at this point up here, based on what I see at the close, which is that little asterisk, we had buying activity. That's what brought us up to here. But at this point, I'm at a point where the market is really non-trending, if you, and that's why I have the cluster.
So that's why the answer is yes.
Yeah.
Buying or selling.
Oh, well, but yes doesn't really, okay, it's a, if you use the term yes for buying or selling, then that would be correct, but you're having both together, you're right. It's a non-trending zone, if you will. And that is what creates a cluster. We have buyers and sellers trading within a particular range. There are other times when it will be very clear that a cluster is buying or a cluster is selling. And we will look at those as well. All right. Of course, anytime you look at the value area, you must also identify the value area low and the value area high. And by the way, those are very important parameters because they will help us with two things. One, profit target levels when we're looking at our trades, and they will also help us with identifying trade opportunities. Last but not least, the famous volume point of control, the most overrated number you'll find, the volume point of control. Now, every market maker, everybody in the market knows about the volume point of control, and so it's really lost its efficacy. It's not what it used to be.
What did it used to be?
It used to be a very important point where price halted and really was respected. But you will see now, quite often we'll get to a point of control and we'll shoot right through it, or we'll come back right down through it. It doesn't really have the respect that it once used to have.
Would you say it's still a good magnet?
It is still a very good reference point. It identifies for me what I would call now a zone, a critical zone. All right? But the level in itself, in its own right, just that one level, really is not that significant anymore. But it's the zone around it is still very significant. Okay.
Is it the same with the point of control?
The same with?
With
Okay. If I understand you correctly, you're making a distinction between a time point of control and a volume point of control. Okay. So the first question is to ask, what is the difference between the two?
Well, the point of control is the place where the stock traded the most amount of time in the session. And this time is actually the same.
Okay. Not really true, because this is a volume point of control, so this is the actual volume. The TPO has two levels which are exactly equal.
Okay.
You see that? So these are the TPOs. The TPOs are the time. So I have two price levels where the market or the auction spent equal time or visited them an equal amount of times at those two levels. But there's only one volume point of control. So the time is, we visited that price level X amount of times. The volume is in fact the highest level of traded volume within that session. So there's my volume point of control. There's my volume point of control. And notice how I have, are these, yeah, the P and P do come down. So these two price levels would make for two equal TPOs.
Okay.
So two equal.
And which one would you give more like?
Each one has its own applications, and I will talk about that in more detail. Time tells me certain things, volume tells me other things. So we will talk about the difference between them. It is a good point, but it's a little bit ahead of where we're at now.
My question was what I thought he originally asked, which I'd like to hear your opinion on, which is, do you see the nature of movement around market points of control as the same as you pointed out, with volume points of control becoming essentially irrelevant right now?
Okay. Volume points of control are by far more important than the time points of control. The market could spend a lot of time going back and forth, and we see this in the evening, with very little volume activity. Okay? It still tells me that in this zone, we're still trading in this particular range, but it is not as potent as when volume comes in.
So that you typically use full Globex profiles for everything instead of splitting out?
I use both. I use the session profile, and I also use the Globex if I'm looking at a futures market. What I would say more accurately is I always trade within context. And within context, it may not necessarily be that I'm looking at the full 24-hour. I could, in fact, be looking at a 2-day. I could be looking at 3 days. I could be looking at 5 days.
Sure.
So I have to look within context. That's absolutely true. But again, that's a little more advanced than where we're at now. Okay. All right. So these are the key parameters of the profile that I just want you to know. One, the value area high, value area low, volume point of control, and then the clusters, which we talked about earlier. And I told you earlier that we will talk about how clusters can immediately tell us direction sometimes. All right, so here, for instance, I had a slight cluster, and it would be very easy to see that at the end of this cluster, the buyers overcame the sellers, because look at where it took us higher. So now I know for sure that I have buyers that were able to overcome the sellers in this zone. And now I'm at the next zone up where they've decided to meet each other again, but I don't have a decisive outcome yet. Now, here, once again, is this cluster, and this is an evening session, by the way, is this cluster buying or selling? It closed up here. Excellent. All right. I told you, you would know right away now by looking at a cluster whether you have a yes answer or whether you have buyers or whether you have sellers. And by yes, I just mean whether you have a battle between the sellers and the buyers and we're range bound. Here, it is very obvious that this was buying activity. So this was the evening session. It shot right up to here. Okay, now the day session opens here. And notice what happens. We come right back down here for a retest of this buying activity. Depending on where this is relative to the cluster, I can detect the strength of buying. how much do we penetrate into that cluster? Now notice, very little penetration. So just by knowing these two simple facts, and I begin to see prices moving up again in this cluster, when this cluster starts to form, my bias is to the upside and not the downside, because I know that these buyers are still committed and they held us at bay right here. And sure enough, so when you talk about the probabilities, much higher probability right here that the buyers are really going to overcome the sellers than the other way around. Because when we first opened, and this is sort of one of the most critical periods of the day, when we first opened and we tried to head lower, these guys really showed their might. And they had already showed that they were willing to push prices higher. The auction actually auctioned up quite a bit. We penetrated back into it, but we really barely got into that cluster. All right. All right. The next thing that I want to highlight, so we've talked about clusters, yes?
I may have missed this, but why and when do the different letters start plotting? Like the A.
I'm sorry, I didn't hear your question. Why?
Why and when do the different letters start plotting?
Ah, okay. All right. My mistake, I worked with an assumption. Letter A is what we call a period within the session. In my design of the profile, I stipulate what that period is going to be. So that's a user-specified element.
Okay.
In this particular case, and usually when we set up day session or evening session profiles, the standard setting is 30 minutes for the period. And the idea being, and this is the initial setting that Stadelmeier used for the profiles, and by the way, we're going to look at different settings, but in this case, that's the standard period that we look at. So A is 30 minutes of activity. B is another 30 minutes of activity. C is the next after that. D would be the next half hour, and so on. So on another chart, on a candlestick chart, period A could be represented as a 30-minute candle. Does that help?
Yeah, that's
Oh,
perfect. Thank you.
all right, sure. Please feel free to ask any questions if I don't cover something that, or if I mention something that you are not familiar with. Okay, single prints. This is one of the most important things that you should know about profiles. Being able to identify single prints. And why is that? Because a single print is the hallmark of a shark tooth. Single prints do not occur on a profile because a lightweight has come into the auction process. Single prints only occur when there is a mighty force that was able to bite in and push or hold it, not allow it to come back, or it sailed right down through it. So these single prints are very, very important. And I highlight every single print on that chart. And we will talk more about how we use them and their importance, but they're very, very important. If anything, they're one of the most important elements on the profile chart. And remember what I told you earlier, that there are some things on the profile that many people overlook and don't look at. Single prints is one of them. They don't know what a single print really means and the power of that single print. Okay, there are 3 visual ways to study TPO profiles. We can look at single profiles, as we have been doing. We can look at split profiles, which we have yet to do, and we will look at composite profiles. To re-emphasize, each letter is equal to a particular time period, 30 minutes and so on. In this case, to make it a little bit easier visually, I don't have the periods clustered together. This format is known as a split profile. So if you notice, the periods begin to line up next to one another rather than scrunched together. And it makes it a lot easier to sort of see the lows of a particular period, single prints, and ledges like this. Okay, so notice, we had this level of activity, we break out, and notice when we break out, this zone holds. So this is very strong buying activity here. So I know that if I'm going to put my stop loss, this would be a nice safe place for it because the shark came in and took a very strong bite right here. So, you know, took me up and higher. Yes?
How does that differ, like informationally wise, than like a candlestick chart? Wouldn't that be very similar to a candlestick chart with the different periods lined up next to each other?
Yes, but visually, this shows it to me in a different manner. Okay? The candlesticks don't come so close together. I don't know, for instance, from a candlestick that this was a single print, meaning that the market never came back, or these were just 4 TPOs there. This is a little bit harder to see on a candlestick, and we'll do that comparison. We'll take a look at it together. Okay, so the day session, 30 minutes each, A through N. Each period consists of TPOs. So each of these particular levels within the period, this A, each of these are a time price opportunity. It means the market visited that price level during that period, and there was a time price opportunity where I could have bought or sold. That's all a TPO means. This is some detail in terms of a period, where the high is, where the low is, and the range for that particular period. Now, it's important to be able to identify the open for each period because it's really the close of, the open of that period is where the prior period closed. So the open of one period, it's the close of the prior period. You don't see the close of the prior period, but since this is where the new one opened, it's really the close of the prior period. So the current period open is equal to the prior period close. One other very important fact that I need you to know before we move on to our next presentation, and that is which periods during the session typically include the greatest trading volume within that session. Now remember, I'm not looking for value areas or for the full session. I'm asking about specific periods during the day where typically during that day session I get the highest trading activity. Not the clusters, which period?
The open. The open and the close.
Very good, excellent. And you can see it right here in this little histogram with the volume. Notice for period A and period B, and that's often known as the initial balance. What I want to make sure you also know is the ending balance. Because those two reference points on the chart and during the day have significance. Okay? Very, very important to take a look at my initial balance and my ending balance. Okay? A and B periods, initial balance, M and N periods, my ending balance.
Can I ask you a question about that?
You can ask me any question you want.
So a lot of people trade S&Ps, and stocks and S&Ps last hour has a lot of weight, has a lot of volume. Do you take the same weight to other products? Something like a 10-year note, which trades till 4 o'clock, but the volume dramatically falls off as the day goes on.
All right.
Is the ending balance concept still relevant in things that are not S&Ps or stocks?
Okay. I always like to stay from absolutes. Okay, so I won't tell you that every rule applies everywhere to every single instrument because I will be proven wrong. And there's always some instrument I've never even heard of. So what I'm trying to point out to you is if I'm going to go analyze an instrument to try to get an idea about the pattern of how that instrument trades, one of the key things that I want to look at are the initial period and the ending period. That's all. And then, based on that analysis, I can extrapolate how that instrument behaves. And if, in fact, I find that this instrument does not have the highest volume in the initial or the ending period, then where is it? And why? You see? So that's what I want you to do. There are no absolutes in the market. Good traders learn what to look for and how to analyze. And then you apply that to different instruments. And that way, you're not taking sort of a generic answer that you're trying to apply across the board. We know that as a general pattern, this tends to be true for a lot of instruments. But is it absolute? No. Okay. Did I answer the question?
Kind of. You know, most of the big products trade till 4 o'clock, and the volume patterns, you know, but they have 2 o'clock settles, they don't match up. And the volume patterns in the back half of the day, things like Euro, which is European heavy, or just even U.S. Treasuries. The majority of U.S. Treasury volume is done before 10 a.m. Right? So, is an end of period concept relevant to Treasuries in your mind? And I understand what you're saying, but there's something like soybeans that closes at 120. The last period in soybeans is relevant. The last period in S&Ps is relevant. The 10-year note is very different.
Right.
Okay,
And
so is it relevant, and if so, how do you mitigate different closing times? You know, a 4 o'clock close with a 2 o'clock settle.
well, I have to look at the instrument that I'm trading.
Sure.
Sure. So I would have to look at the behavior of that particular instrument, and that's why I want to identify the periods that tend to see, and you will see there will always be a pattern, whether it's treasuries, whether it's gold, whatever it is, and sometimes also that could help identify when I have an anomaly. If all of a sudden I'm seeing unusually high volume in a period where I usually don't,
Sure.
that could be an indicator in itself. But more importantly, it just helps me to focus on understanding the instrument and its pattern, be it ending, beginning, or wherever. All right. Single profile views, I'm running a little late. Okay. Let me see if we can just, I have just a couple more slides and then I'll wrap. The composite, we looked at the split, we looked at a single. The composite is when we blend 2 profiles together to create a composite. So if I have an evening session and a day session together, they're going to look like this as a composite. And we will look at composites as well because they give us important information. And this, again, is the kind of thing that a lot of people don't look at. They don't look at the composites. Okay, so last but not least, a profile-based trading plan has 3 key components. We want to analyze, and in doing so, we need to look at context, weekly and daily, and then we identify opportunities, targets, and the stop loss, and then we get into execution, how we enter, how we monitor, and manage the trade. That's it for me for the first segment. Any questions?
It seemed that the big takeaway was that you saw what they were trying to do on the overnight, which implies that size will take control of it, and they had a position they want to get on, get set for the day. Get in position for the daytime, and then to feed into the morning or whatever, and then move it out.
There's a corollary to that as well. What happened in the evening session relative to my ending balance? I didn't show that, or I didn't highlight that, but so it's not just about one thing. It's usually more than one thing. And you will see that in my evening session, the buying activity actually started in the ending session of the day of the prior day session, and then they continued in the overnight session. You see,
Right.
and then the next day session, I should then, having seen that, be able to, at minimum, have a bullish bias.
Just to be a buyer.
Right, just to get a bias.
It seems like they make the big move overnight and then chop us up for a couple hours in the morning and then move it again.
Well, quite often that's the case, but really in this case, the big move didn't occur overnight. There was just a lot of grinding overnight, okay, building the position, so to speak. Everybody that wanted to sell, okay, give me what you have, give me what you have, and then it shot up. And the reason it shot up right before the open was really to trap a lot of the amateur buyers, and then drop on them, and then have them all sort of hightail and feed the move up. That's how it happens. All right. All
I
right.
got a question.
Sure.
Could you go back about 3 slides?
I can go back as many as you want.
Maybe more than that. Oh, right there, right there.
Okay, right there.
All right, you notice, you get the day session, you've got the POC up there on the far right. You got your volume.
This one back there?
To the right, to your right.
This one?
No, keep going.
Up? This one?
Up there at the top.
Yeah.
Notice how that volume put in right there. Now take your pointer, same level, and go to see where it filled in that weaker volume area over on that.
Way back there?
Yeah.
Okay.
How often does that happen? I've seen that quite a bit, where we'll go up, and it's a low volume area like that, and we'll go to that area and fill that, and we'll fill in the volume that was left prior to.
Okay. Now, you can see that on a composite, so that's where the composites will come into play. That will be quite helpful. But really, what this tells you here, when we come and we breeze right through that single print up there,
Right.
is we know we've vanquished that seller.
Yeah, but what I'm saying is that I have noticed that when we see, if we start our day, when we see that volume over there on the left,
But wait a minute, you're starting your day down here.
well, no, I'm talking about keep going, keep
Okay.
walking, keep
All right.
walking, keep going. One
Okay,
more.
which start?
One more, right, keep going next.
This here, right here?
Yeah, see that volume that you
Yes.
got your finger at?
Yes.
That's the opening of that one.
That's correct.
Keep going to the left.
Okay,
All right, right there.
okay,
Now notice the volume in the gray,
yes.
right there. See where we had that thin spot in that
This
profile?
thin spot right here.
That, yeah, those
That's
little
right.
prints right there, you see that volume. Now move your pointer to the gray.
Yeah, right here.
there. See where it's thin?
Right
Above
there.
it, right there.
It's thin there, that's
Now
right.
take your pointer and go all the way to the very end, see where we went with volume?
You mean
We
here?
fill that in. We fill that gap.
Right?
That's where we fill that gap. How often do you sit and look at the profile and go, there's an area of probably where we're gonna stop? It's a target.
Okay, now, I know that this is a target because I know that we had strong selling down here, very light volume, and then the volume began to get heavy, but the result of this heavy volume was selling that brought us down here. So the key question, to answer your question, is I know there's sellers down here. And so when I start to move up, what is going to happen when I confront these sellers that were up here?
Right.
Okay? So, in other words, this becomes a target zone for me. And so if I was long and we
Yeah.
got into this zone, I would probably be taking some of my profits
Yeah,
right
that-
away.
That's what I'm saying. And
Right,
I've
I
seen
wouldn't-
that over and over and over.
Right. So, well, the most important thing is this shows you there are sellers here. And so when you get to that zone, take your profit. How do you know whether it's going to go through it or not? You don't.
Right.
And so at that point, I capture my profit and I wait and see. I get out of the market and I'm one happy camper if in fact I manage to capture that much of the move. I don't have to capture the whole thing.
Right.
And that's key, by the way. You don't want to think you can get a move at the, at the very bottom and get out at the very top.
Right.
That's not what peak performance is about. And certainly, unless you're Goldman that's planning the move, you can't do that.
Right. Yeah, I just noticed those weak areas and those singles, and if we're heading up, that's usually where it stops.
Okay.
And it fills it in, it fills that.
Yes, absolutely. See, it had to fill it in because there were a lot of sellers there. Selling was heavy there, so it's going to take it a little bit of effort. I'm going to be out of there. I'm not going to sit it out because I don't know. For all I know, that seller could overcome it and bring me right back down.
Yeah, let me step right back in.
Right.
One question on
Yes.
the single print. So you're saying the single print represents large money, big players?
Absolutely.
So as I look at the single prints here, I see no volume.
Okay, that's just the key. The intensity was so strong, nobody had the strength to overcome it. It just squashed right through them. Imagine a freight train coming at it, and you're trying to hold back the freight. You couldn't. It was so strong. This is really strong momentum.
So how does that manifest itself? Not in the number of contracts? Wouldn't it be, how does it, I understand what you're saying, so strong.
Here-
How does that manifest itself?
Here's how it manifests itself, okay? I have very intense selling pressure from above, okay? And all of a sudden, the market maker's inventory, in terms of trying to balance their inventory, they want to come down and they need help from other buyers to buy with them. Because their inventory of buying, the selling was so much, their long inventory is starting to fade out. A market maker's job is to make sure that they always balance their inventory. They don't want to be heavy on the shorts, they don't want to be heavy on the longs. So now, wait a minute, they're coming at me real strong, the auction drops even further, and I go further lower, looking for buyers to come in and support me. Because these guys are throwing way too much at me. So the market then just drops real quick, no volume like you see that, the single print. So that shows me intensity from above. And similarly, if all of a sudden I've got a lot of buyers coming at me, whoa, I'm gonna jack the price right up. See that? That's how that works. That's why you see no volume.